Warriors of Wealth, and I want to spend some time with you talking about how it works to do a value add apartment project. So we have multiple people that are in our mastermind, in our Apartment Accelerator Mastermind, which just launched in June, that are getting to the point where they're starting to close on properties, get properties under contract. So a lot of our live at 5s that we do every Wednesday at 5 p.m. Pacific are talking about the updates of our students. So I thought I would take some time and just educate you about how the numbers work for a multifamily apartment complex. Now, when it comes to apartments, what we're talking about are 5 or more units. Because in this Facebook group, we focus on everything from 2 and up units, right? It's multifamily. It's really rentals, just multifamily tend to cash flow better, so we focus on that. But 2 to 4 units are valued one way, and 5+ units are valued differently. So that's what I want to explain to you today is how are they valued, what is it based on, and then I want to take you through an actual case study of one of our students to show you what does that actually look like in practice, all right? And also we just want to give a shout out to Batel, who's been in our program this year, and she's actually just closing today on a 9-unit value add project in Florida. So we're really excited about that. And then also Steve just got a 16-unit under contract in Florida doing a value add project. Brad and Marlene just had a 21-unit and a 16-unit under contract, both value add projects. And Joni had 2, a 6-unit and a 9-unit under contract that are value add projects. So not that everybody has to focus on value add, but the reason they do is because of how much money that you can make if you successfully take the project from not performing well to performing really well, which is what we focus on teaching them how to do. So want to just spend some baseline education time with you today, showing you how numbers work so that as you're going along your journey and you're figuring out like what do you want to focus on, you'll know what's possible for you. All right, so let's start off by establishing the baseline. Just the first thing that you have to know when it comes to apartment investing is about net operating income. Okay, net operating income, we use the letters NOI, net operating income, to talk about net operating income. Or to talk about this number. So you're going to hear me say that a lot, NOI. So NOI is equal to the income of a property minus the expenses is NOI. So income of a property would be things like rent. It's primarily the rental income, but it could be storage, laundry, vending, any money that's coming into the property would be considered income for the purpose of NOI. Now expenses are a little different because most of the expenses of a property count for that, but there's one that most people think does and it doesn't. But the expenses include things like property taxes, insurance, property management, maintenance, repairs, leasing fees, things like that. Those are tenant turnover, eviction expenses, legal fees. Those are all considered expenses. The one line item that's not considered an expense that most of us are highly aware of when we're calculating our numbers is the mortgage payment. In multifamily over 5 units, we call that debt service. All right, so this is everything that it takes to operate the building regardless of how it's financed. All right, and then the difference between the two is the net operating income. Now in apartments over 5 units, we always have to take this number that's NOI per month and annualize it. And the way that we do that is we just take the NOI and we multiply it by 12, and that becomes annual NOI. Okay, so that's a foundation principle that you need to understand as you're going into this so that you understand the whole, or you can see the vision of what you can do with apartment buildings over 5 units when you increase this. Okay, but you gotta know how to calculate it. All right, so make sure you have that written down, and then let's move on to the next part. So the next thing you need to know, actually let's just do it right here. The next thing we need to know is the value of a property. So the value of a property is gonna be the NOI divided by the market cap rate. Okay, now the market cap rate is a percentage, and the market cap rate is just it's the capitalization rate at which things are trading for or selling for in any given market. So in this particular case study that I'm going to show you, it's a market that had about a 10% cap rate. Now most markets have a lower capitalization rate than that, and the lower it is, the higher the value will be. So this was more of a market that was definitely a cash flow market. Cash flow markets are one that tend to be cap rates that are 9 to 10% and higher. And then markets where it's really good, typically really good value add opportunities are usually a little bit in the lower range. But this particular case, it was such a good deal that it was a great value add opportunity, even though it was in a higher cap rate market. All right, so NOI divided by cap rate, that equals the value of the property. All right, so those are the pieces you're gonna need to know as we get into the numbers here. All right, so this case study, what we're talking about is 26 units, all right? 26 units. The purchase price was $210,000. And then the rehab was $45,000. Okay, so all in, it was $255,000. Now this particular project was a bank, because when I show you the numbers difference, you're gonna be like, who would have sold it for that cheap? It was a bank-owned foreclosure. So the borrower had got into default and the bank took it over. They just did a terrible job managing it, of course, because they're a bank, they're not a property manager, and they didn't know what was going on. So they had rents coming in, they didn't know what units they were for, what tenants were in there, who was or wasn't paying. They didn't know who had security deposits. So it was just kind of a hot mess. Well, our student, Robin, went in and was able to pick up this property for $210,000, and like I said, needed about $45,000 worth of work. Okay, so that's the foundation baseline. Now, when he bought the property, and this is a project that we basically coached him through over the course of 6 months. So when he bought the property on day one, let's say that the revenue was $8,000 a month. Okay, that was the rents that were coming in, $8,000 a month, and the expenses were $71.50. Okay, so the difference between the two is the NOI, but that was per month, right? So the first thing we're gonna do is we're gonna multiply that by 12. All right, and 850 times 12 is, let's see, 10,200 per year. Okay, so if we're looking at like what is the value of the property, if we were valuing it based on this, we'd say, okay, well the NOI is 10,200. The market cap rate was 10%. All right, so if we take 10,200 NOI and divide it by 10%, then we'd say, okay, well the building is worth 102,000. Okay, so if he was buying it based on the current operations of the building and it couldn't do any better, he really shouldn't have paid more than 102,000. All right, so why did he pay effectively 255,000 for it? I'm going to show you in a minute what happens when you increase the NOI and how that impacts the value. All right, so I'm going to leave that 255 there, but 102,000 is technically what the property was worth because we only have a 10,200 net operating income. Oops, I could probably leave that revenue and expense number there. All right, so 6 months later, so we're basically going through, I'm helping him come up with a plan. We're identifying who the current residents are, who's paying, who's not paying, evicting the non-payers, filling units, etc. So this is about 6 months in, and that wasn't even the whole project, but this is at the 6 month mark. The revenue had gotten up to, we're I think 11,500, yeah, 11,500. And this is just all strictly from the rent rolls and everything else. These are real numbers on this real deal. The expenses, we didn't focus on decreasing the expenses at that point because there was so much upside in the revenue. So the expenses were still $71.50. So what is the NOI? It went from $850 a month to $43.50 per month. That's, that's not bad, right? I mean, it's not like, wow, we went from $850 to $43.50. You're not gonna change your whole life with, that kind of change, but hold on a second. So what does that mean on an annual basis? We went from 10,200 to 52,200 NOI. All right, well now we're talking. Now that's a pretty big difference. So let's look at what is the value of the property based on that. And remember, value is NOI, which is 52,200, divided by the market cap rate of 10%. So if you get out your calculator right now and you put in 52,200 divided by 0.1, what do you get? $522,000. This is the new value of the property, but this is how much he was all in. So 522 minus 255. So, and that was only 6 months. As we continue to operate the building and continue to improve it, the income continued to go up. But this is at a snapshot in time, only 6 months in, and it already increased the value by not quite 300,000, but like around 275,000, a significant amount, and continued to do so. So when you hear us talking about value add opportunities, and you hear us giving the weekly updates on the Wednesday Live at 5 of who's doing what, who's closing on what, or who has what under contract, you'll hear me say frequently value add. It's because a lot of our students see this opportunity and they basically want to increase and improve their wealth through apartment buildings. Now, some people who they're like, I don't really want to do that. That takes a lot of time. That's true. If you have capital and you just need to put it into play, you don't have to do a value add opportunity. You would just buy something that's already performing and just get immediate cash flow. And that's fine, especially if you have capital to just sink in and you're not interested in doing the value add. Totally an opportunity. But a lot of the students that come to us into our mastermind, they're like, that's cool, but I really want to have these, multiple 6-figure hits to my equity and increase it, because in a few years, then you can take it, do a 1031 exchange into a bigger building that is just going to be for cash flow and maybe a little bit of value add. So anyway, just wanted to give you some context for how that all works, why our students are focusing on value add, and even our students in the mastermind who are focusing on 2 to 4 units, they're still doing the same thing. They're doing a lot of rehabs because the ability to go in and improve the value of the property increases your net worth. And down the line when you refinance, you can either pull cash out or you could sell, roll those profits into another building. It's life-changing. So anyway, I hope that helps. I hope you found value in that. We look forward to seeing you every Wednesday at 5 p.m. Pacific right here live on the Facebook group. And we're always here to answer any questions during that time. So bring them over, and we'll see you soon.
If you're interested in learning more about real estate investing or investing in passive income, multifamily, or apartments, feel free to join our free private Facebook group. If you know that you want help, you want someone to hold your hand, and you want to be part of a mastermind and have coaching, all that you need to do is text the word freedom to 619-373-8461. So if you just want to see what is that about and how can I speed up my results and do it more safely, I'd be happy to chat with you about what your options are and see what we can do to help you along your journey.